Hey guys, Killstokes here. Welcome back to a Weekend Trading Edge video. I apologize for no visual me this week, but I've spent a week on the road. I'm very tired. I don't feel like setting anything up, but I do feel bad about missing a weekend video because I love you guys. So I wanted to hop in and give you something. Now, before we get into the charts, I want to give you a brief recap of some of the important fundamental stuff that has happened this past week and is happening this coming week. I will go into more detail with this, hopefully in a video version of the Trading Coach podcast on Monday, but just to give you a few headlines. One, Japan has been suspected of intervention. We spoke about this on Trading Coach Podcast episode 1309. But yeah, they've been suspected of currency intervention against the yen on Thursday, Friday. And that's why you're seeing the things that you're seeing on your chart. Other things in the news is going to be more geopolitical tensions, meaning war. So on Saturday, U.S. President Donald Trump stirred the pot a little bit once again, signaling renewed military action against Iran. And just for a reminder, for those who don't join us on a weekly basis, signs of war, meaning more war, equal dollar strength. Signs of war ending equal dollar weakness. Following up on President Trump, we also had him come out and threaten more tariffs against European autos. So yeah, we got that too. Now, coming up this week, there's a few things happening. Today, Sunday, we have OPEC news. That's going to be oil related. On Tuesday, we have an Australian interest rate decision, an interest rate hike, or at least an expected interest rate hike. And then with this being the first week of a new month, on Friday, we have our jobs reports in the US, which is our non-farm payroll. So that's what's in the headlines for this week. And again, I'll dive into that in more detail in the next episode of the Trading Coach podcast. Now, let's hop into the charts. So, as I mentioned, Japan has been, I'm doing air quotes, suspected of currency intervention. And the conversation we had in the past was about Japan not liking a weak currency because of imports and all that fun stuff. Again, go back to that episode and listen to it if you want more details. But you can see what the intervention caused. A big red candle. We've then followed it up with some consolidation. By the way, I'm on the euro yen. I'm brain farting all over the place because I'm tired, but we are in the euro yen here if you want to follow along. We've seen an inside bar right here, which is going to be consolidation. And as we go down to a lower time frame, you're going to see a classic pattern formation. It's not the prettiest one in the world, but it technically still counts. And this is going to be called a double bottom. So you can see that price action dove down from our highs of 187.5 right there, all the way down to about 182.22. Yeah, about 530 pips, a pretty big move. We then got a little bit of a bounce or relief off of that. And then we came back down to retest that previous level of rejection, right? This is what's going to give us that classic double bottom formation. And this is going to be a reversal formation, a reversal signal in the market. Now, we can always look left structure leaves clues. We can see that this double bottom also forms at a previous level of structure, support. So if you were someone that was looking to get long, this would have been a decent opportunity to get long right here. However, if we remember the three parts of our trade, our E, which would be the double bottom, the entry, our S, which would be our stops, and our T, which would be our targets. If we remember those three parts, we're going to see that although you may have the entry signal for a long, the rest of the trade may not work out as great as you'd like it. And here's why. So if we're entering this on a classic double bottom, technically our double bottom completes right here at the end of this red candle. So this would be our entry. So the next question that we have to ask ourselves is, okay, well, if price is likely to go up, where do I think price is likely to go up to? And there's really two levels that stand out for me. If you are super conservative, there's a nice inside level of structure right here around 185 even that you can look at. I'm pretty sure there's a 50% retracement here as well, maybe. Yep, right in that level as well, a 50% retracement. I swear I didn't do this earlier. I just got those fib eyes like the Terminator, right? So we have that right there. The more important level of structure, in my opinion, would be this one right here. So we can see as price action came up from this level, and again, if you're a beginner, this is a great way to just train your eyes to identify structure. we kind of just connect the dots, right? We bounced down, we bounced up, we bounced down, we bounced up, we bounced down, we bounced up, right? And you can see a common area right here where price action held. That's going to be about 186.16. Maybe you get a little bit more conservative and you move that down to the 186 even handle as well, just to take that psychological level into account. I should do the Fibonacci thing again, but I think I'm going to be wrong, but I'm going to try it anyway, see if I can go 2 for 2. 786 right there. I should have just stopped. Anyway, something else we can do is we can bring some volume in to see if there's any type of volume-based clue. Oh, here we go, at this level. Now, I did get a good question on the YouTube comment section. Again, words aren't really working for me, about structure in volume. I think the question was, do we need volume at a level of structure for said level of structure to be important? And my answer is no. My other answer is you can do whatever the hell you want. But for me personally, it is no. Structure is going to be most important, first and foremost. What the volume does is the volume allows me to see the difference between where within that structure level is the most important area, or make a decision between, like if I'm fighting between two areas, which is more important and which is less important. And you can see right here, we had two areas on our radar. We had this top zone right here, which actually doesn't really have a lot of volume on it. So you can even push that projection maybe up a little bit higher if you want to be aggressive. But we also have this smaller zone, which I said looks insignificant, and we do see a little bit of a volume spike there. So it may be more significant than we think. And again, this is my first time doing this analysis, guys. So this is all new to me. So this is how I like doing the video. I don't like pre-doing it because you don't get my fresh takes, I guess it is. But so I would actually pay attention to this 185 half. Also, keep in mind, I mean, we're going against the intervention of the yen. Right. So like the general consensus of the market is like, hey, we are going to be scared to sell yen because because intervention may have happened on it. So this is a pure counter trend type of move where you're not looking for a continuation. You're not necessarily going with the flow. You're going against the grain. So let's just take this as our target level right here. We're being conservative. This is our entry, right? So we have that part done. We know that, hey, if I enter right here, I'm looking to take profit right there. Here's my little profit face, guys. Nope, not that. We'll save that for later. Bang, there we go. The next question we need to ask ourselves is where is our stop loss going to go? Now, my stop loss always has to go below the lows, and these long wicks don't make life that easy. I'm going to do quick math here, not to make this video too long, but if I just put a stop loss, let's put it 181.50 here. That's going to be about a 1 ATR stop. My stop loss is going to line up about right here for this trade. And what you can see is as I look at my risk profile, my risk to reward profile, you're going to see that I'm not going to have as great, 185 even, there we go, as a risk reward ratio as I need, meaning that my risk is going to be much greater than my reward. Now, that's not always a bad thing, right? It depends on your trading style and your trading stats. If you're someone that hits at an 80% rate, you can have a inverse risk reward. I'll throw in the risk reward little matrix chart so you guys can see it. Me, I am not that type of trader. I am typically between 50 and 60%. So I need a positive risk reward in order to make consistent profit. So this would be a trading opportunity I could not take advantage of yet. Because what we can also do is look for a secondary reason for entry. And this was another question that came up on the YouTube where it was like, hey, if I get a signal and the signal is invalidated, can I still take the trade? And I said, yes, if you have an alternative reason for entry. And this is where a 2618 trade would come in. So for the 2618, we would need a few things to happen, right? One, we would need our double bottom, check, which we have already. Two, we would need price action to break and close above the high of this double bottom, the peak of this double bottom. And then three, we would need to retrace back into said double bottom, giving us a nice little pullback. And then this is the opportunity. I'm going to do a bunny rabbit. I have no idea why. This would be the opportunity where you would look to buy on a move back up. Now, here's what's very important about this. This would only make sense, or it would make sense more only if you are someone shooting for this higher level. Because if you are only projecting price to go to this first level and you don't want any more involvement in the market after that, Well, by price action breaking and closing above this peak, if it were to go to that level, we would consider the move to have already be made, meaning the level in which you projected price to go to, price has done that already, meaning you're not necessarily, because you're not projecting it to go higher, kind of the trading opportunity is over. So you got to keep that in mind. But that's going to have more to do with your overall projection, whether you're saying, hey, this is going to be a conservative target, but I do think price is going to fully correct itself and go back up to the highs. Or if you're saying, hey, I only think price is going to go here, up there, and there's no way we can get up there. So that's going to be the difference maker in this opportunity. And if you look across the yen pairs, we're not going to look at all of them, but there are a few other opportunities like this as well. But this one had the most profit potential, especially to that higher zone. And real quick, just so you guys didn't think I'm lying to you, here is the dollar yen. You can see a much more beautifuler double bottom, right? Much better entry down here. But our inside level of structure is going to be a little bit higher right up here as well. So again, still not a lot of opportunity here. Let me just measure this out real quick because I'm curious now what this would look like. We know that our entry would have been right here for the double bottom. Target is only right here. Maybe you get a little bit greedy, go 58 even handle number right there. Stop loss, we're looking at, what is our low here? So we're looking at 30s, no 70s, yeah, 70s for our stop loss. Somewhere around here, probably. Yeah, you're still not going to get a great risk reward unless you're using a very small stop there. So again, look across the yen pairs if you like these type of opportunities, and you may find one of your liking. Next up is going to be the Kiwi, the New Zealand dollar, and this is an interesting one. New Zealand has its own stuff going on this week, and I forgot what it was, so give me a second. I'm going to filibuster. I know we have the interest rate decision for the RBA on Tuesday. Nope, just employment numbers for New Zealand. No rate change, I believe. Rate change, nope, governor speaking. Okay, so yeah, no big news for New Zealand this week. So here's the interesting thing about this New Zealand dollar. Again, we are in consolidation, so we don't really have a directional bias. And what I mean by that is that I have no reason to think that price is more likely to go up versus down. I have no reason to think that price is likely to go down versus up. And there's two ways you can handle this situation when you see this on a chart. And you are going to see this on a chart a lot, especially in the Forex market, because a lot of the time the market consolidates about 70% of the time. And the two ways you can handle it is this. One way, you just say, next pair, right? Nothing to see here. Next pair, I'll go on to something that gives me a clear directional bias. The second way is you become more of a trading mercenary, where instead of looking for any type of extended move, you're just asking yourself, where do I think price is going to go to next? And does it offer me a good opportunity to get involved? And here's the interesting thing about the Kiwi here, right? This is going to be, and I don't know if this pattern has a name. I'll go ahead and look in my encyclopedia of chart pattern books after this. Or if you guys know the name of this, feel free to type it in below. I'm generally curious about it. But this is going to be the opposite of an ascending triangle, right? So in ascending triangle, we have this. An ascending triangle is one of my favorite patterns to trade. We have a directional move to the upside, and then we have a little bit of a retracement. And then we have a retest of that structure. And then we have another retracement. Now the key is, right, the retest of the structure is somewhat equal. The retracement is going to be higher, right? And we get this formation where we have this series of equal highs at the top, higher lows at the bottom. And the idea is that price action is continuing to test the previous highs. However, each time the bears, or the sellers in this case, try to push it down, it does so with less and less conviction. And eventually we break out to the upside. Kaboom, right? Wonderful trading opportunity. It's fun. It's simple. It's easy. I love it. Now, look at the story of this one. This one's kind of the opposite, right? We have a clear directional move up. We have our equal highs, right? But instead of these lows getting higher, these lows are actually getting lower. Now, in a megaphone pattern, we would see these highs getting higher as well, like that, or a broadening wedge. But yeah, I don't actually know what this is called. And it doesn't really matter, to be honest with you. I'm curious because I am a chart nerd. But What matters more is the story. So just as the story here said, hey, each time we get to this level, right? Hey, that's how the market speaks. Hey, each time we get to this level, it's pushing back weaker and weaker and weaker, which means if it's weaker sellers, probably stronger buyers. This one's the opposite. Each time we pull back, kind of / extend, we're getting deeper and deeper and deeper, which is a sign of more selling pressure than buying pressure. And what we have at the very top of this theme of the day, is a double top. You may need to go down to a lower time frame to see it more clearly, but we have a push to the high, we have a retracement, and then we have a beautiful double top right here. And for those of you, right, you tier 1 traders out there, I know some of you guys do this. For those of you who like confirmation after your double top as more of like a conservative entry, you have the lower low, lower close right here. So we have the double top, we have a nice rejection on the high side, we have a consistent pattern of lows getting lower right here. This is not a bad trading opportunity, right? We put this risk reward here and look what we have. We have, let's say we got short, we'll do it 2 ways, right? If you got short right on the double top, you get short right there. We have our stop loss, which is gonna go about 159.45. So about right here. I don't know if anything is, we got a little bit of overlapping structure. So maybe take that into account if you're able to. So if you're able to, you'd want to get above this level, but that's pretty far away. We'll see. But if this thing is going to push down, we should, right? If the pattern stays true, push down and retest our previous lows. Now you can always shoot for the extension as well. Again, I would be cautious about that just because in general, we don't have a directional bias, right? If we did, then yes, shoot for the moon, but we don't. So at least shoot for a retest of the lows here. But this is a pretty decent trading opportunity, right? A 2-to-1 risk reward there. And even if you wanted more safety, and I don't actually think you need to be this safe because I rule of thumb for anyone new is my philosophy on stop loss is your stop loss needs to go at an area where the market tells you that your prediction is wrong. But at the same time, you want to give it a little bit of breathing room, and you don't want a stop loss that looks like this because you're going to get screwed, right? But I don't necessarily think you need a stop loss all the way up here to know you're wrong. I think a stop loss, I think you'd know you're just as wrong. Where is it at? Right here, 45, as you would up there. But if you wanted to, you always could do that. And even if you're someone that entered late here, obviously this has to be part of your rules. You can still get a decent, maybe just about a 1-to-1 if you enter on the open there. So that's a really cool opportunity and a unique one. I'm not sure I've ever talked about this in a video, and it's kind of fun. And this is why, again, I've told a story many times about younger Akil would just like write patterns on note cards and try to memorize them, and thought that trading was just like being able to say like, hey, head and shoulders, double top, 3 blind mice, all that fun stuff. It's really about just your ability to read a price chart. And this is why I put so much emphasis on our first training course. It's called the foundation course, right? Well, we have the cornerstone, which teaches you like the basics and all that fun stuff like stop loss and brokerage and essential bank, whatever like that. The first like technical course is called the foundation. And it's a study of price action. And between the foundation and the foundation 2, the main goal is just to teach you how to read price. And my philosophy is that if you can understand how to read price, it doesn't matter if you know the names or the formations or whatever like that. As long as you can identify them and understand the story that they're telling you, you can dissect and interpret the market in a way that makes you dangerous and in a way that allows you to consistently extract profit from it. So this is a cool example right here. And then going off of our theme for today, right? If you're someone that wants to be even more conservative, 26.18, once again, wait for the violation of this level, look for the retest, and look for an opportunity to trade it low. You'll pretty much have the same type of risk rewards. That's something you can look for as well. So really, really cool opportunity. I'm looking for anything else here. Do we have any divergence clues here, right? We don't have any, like price is doing what it's supposed to do. RSI and price is lower. RSI and price is lower. So there's no like signs of slowdown, right? If we were here and let's say our RSI was giving us something, I'm sorry, I'm getting real nerdy here, guys. RSI was giving something like that, that would be considered divergence, which would not be a great sign for a bullish trade because it shows us that the market is running out of steam. But we don't have that. So the RSI is in line with everything. So Yeah, we even have divergence here at the top. So yeah, cool opportunity. Well, it'll be interesting to see how this plays out. All right, we got past the fun price action stuff now to something simpler, at least simpler for me, an advanced pattern formation. And I got another comment the other day asking Akil, you say pattern trading is boring. What do you mean by that? Like, is boring mean bad? And I mean, no. I mean, like, for me, advanced pattern formations it's boring because it's simple. It's pretty much, I just follow the rules. I draw in some fibs, as you'll see me do in a couple seconds, and I follow the rules. What brings me joy is kind of the analysis that we did on the previous pair, where it's like I'm reading price, I'm dissecting the moves. Not that trading should be about making you feel good and like you're doing something, but let's be honest, like I don't know, I feel kind of better when I feel like I'm actually doing something in the market versus like using a cheat code of just like drawing fibs and following the rules. Again, newer traders, do whatever makes you money. That's the real thing. But I just get more personal joy out of pure price action trading versus pattern trading. But I love pattern trading, and I will continue to pattern trade because it makes me lots of money. So anyway, we have an advanced pattern formation here. Again, market is kind of doing a sideways shuffle in consolidation. This is the perfect time to look for them. We have a clear directional move, a swing low to a swing high. That is going to be our starting point, our X leg to our A leg right up here. I want to drag in my Fibonacci retracement tool from the low of that starting point to the high of that ending point and see what Fibonacci level does our first retracement come to. And you can see we come to a 618 Fibonacci retracement, putting us on Gartley pattern alert. There's different ways to trade the Gartley. Me personally, I use a 127 from the A leg to the B leg, and I'll draw these letters on soon. And this is going to end up being my completion point. So it ends up looking like this: X to A to B, first retracement, B to C, our failed extension, and then a CD completion right here at the 127 with the potential reversal zone, going from our 127 all the way to the low of our X leg. So this is the area in which you would look to buy. Either aggressively limit order at the 127 or wherever your entry reason is at, or look for a reason for entry if price action gets into that zone. But a cool bullish opportunity there. And then one more pattern for the road. The last one was a Gartley pattern. This is going to be a bat pattern. Once again, we start with a clear directional move. We call this a sore thumb move. I don't know if that's a reference that people overseas understands, but a sore thumb is like, sticks out like a sore thumb, like a good old Tom and Jerry cartoon where they hit the thing with a mallet and the thumb gets all big and red. You can spot it. It's easy to see, right? This is clear as day. So once again, that's going to be our X to A leg. We're going to take our Fibonacci retracement from our swing of low to swing of high. This time, you can see that we nearly miss the 618. And no, a near miss does not mean a hit. Either it hits it or it doesn't. Again, these are boring rule following setups where it's black or white, one or the other. There is no room for debate. And if you are going to put in a rule for close enough, because I know that certain books and certain teachers do teach about like a buffer zone, that is fine. I am 100% okay with close enough, but you have to define what close enough is. So you can't just look at it and be like, this one's close enough, and then have the same thing happen next week and be like, that one's not close enough, because you're going to be acting on like these subconscious biases. So you need to have a rule. Close enough is if it comes within a certain percentage of the Fibonacci level or a certain pip amount of the Fibonacci level. Again, there's nothing wrong with doing that. Just make sure it is defined. That way you can be consistent with it, because, say it with me, consistent analysis plus consistent execution equal consistent results. So this one doesn't come to the 618. So it comes to the 50%, which is going to put me on alert for a different pattern. This is going to be called a bat pattern, my favorites of the pattern, mainly because of the consistent risk reward. But once again, we have our swing low to swing high, X to A. Our first retracement is our A to B. Our failed extension is our B to C. And then our 886 right down there is going to be our CD completion, with our zone being from our 886 to the low of our X leg. So hope you guys enjoyed today's video. Again, be on the lookout for the next Trading Coach podcast episode where I'll explain all the funny mental stuff that happened and what is going to happen this week. And also, championships are done, so my busy season is over. So expect more videos here on YouTube, and make sure you subscribe and like. That way the algorithm shares them with you when they come out. Because if you miss them and then you miss opportunities and are sad, you have no one to blame but yourself. All right, goodbye. Go Toffees.
The best in the game, invest in my name. Check no restraints, I'm obsessed with the pain. I ingest, I retain, assess and I change. Possessed by the thought I'll be free one day from society's restraints. Money, clout and fame, mud, disease, a plague. We all love to hate, have to play the game, have to make a name. All our insecurities are on display.